second half of the session. We have two more papers this morning. The first paper, Real Effects of the ECB Quantitative Easing, a Housing Portfolio Channel by Chang from Fudan University, Marcel from University of Groningen, and Alex Rebucci from Johns Hopkins. Presenter will be Chang from Fudan University.
Okay, thank you for having me. Can you see my screen?
Just 1 second. For some reason,
I think somebody
else from my.
So I have to. Is this okay?
Yes, it's coming back. Yes. Okay.
Great. Let me share my screen. Okay, so this looks. Okay, all right. Thank you very much for having me, Chang from Fudan University. This is a joint work with Kaat from University of Groningen, Alessandro Rebucci from Johns Hopkins. Alessandro is here also, so he will handle any questions in the chat. So the title is Real Effects of the ECB's Quantitative Easing, a Housing Portfolio Channel. Now, let me give you a motivation. We know following the global financial crisis, advanced economy central banks have adopted new tools to stimulate this economy because the short-end interest rate has been stuck at 0. The new tools are called unconventional monetary policies. On the one hand, what they could do is to directly purchase long-term assets from the private market to affect the long-run interest rate and expand their balance sheet. This is called quantitative easing, or QE. In the context of ECB, they also allow interest rate to go negative. Those are new monetary policy tools, and to study the transmission mechanism of those policies are time-honored questions. Now, in particular, what are the real effects of those policies? And what are the transmission mechanisms? And in particular, what is the role of housing, credit, and financial market during this transmission? Now, in this paper, what we do is to propose a new housing portfolio channel that differs from traditional credit and collateral channels. Now, what is housing portfolio channels? Well, it refers to the fact that when central banks do QE, that lowers the net supply of bonds to private sector and depress the expected returns on the bonds. And the private sector is to do a portfolio rebalancing from bonds to houses. And they can do so through financial intermediaries. They can also do cash purchases to rent out for income. And whatever they do, this portfolio rebalancing can beat up house prices and lowers expected future housing returns. And together, the future portfolio returns gonna decline, which can stimulate this current consumption and output. And those channel is what we call the housing portfolio channel and do not need any role for traditional credit and collateral channels. Now, given this channel in mind, we're gonna identify this channel using German regional level data and study the transmission mechanism of QE by ECB. And we're gonna run a horse race with the traditional collateral and the credit channel and show the importance of a housing portfolio channel in the data. And for that purpose, we're gonna collect the rich regional level data in Germany and explore the geographic variation in land scarcity to identify the real effects of QE. Now, before I show you the preview of results, let me talk about why do we want to study Germany? Well, the reason being that Germany is an ideal laboratory because it experienced a housing boom without a credit boom. Now, here in the macro data, you can see the house prices rises with rents after 2009. And interestingly, meanwhile, you do not see a rise in credit. Rather, you see the opposite. So domestic housing credit to households actually declines. And this phenomenon is coined as a housing boom without a credit boom in Germany. So that makes Germany an ideal laboratory to study the housing portfolio channel. The other thing is that German household is also interesting to study because housing portfolio is a large share in their house wealth. And moreover, the German household do not have a high home ownership. The home ownership in Germany is around 50%. And consistent with the macro fact, German households do not have a high leverage. Their leverage is rather low. So taken together, German environment is ideal because one, you see a housing price boom without credit boom. Two, that German households do not take too much leverage, and housing is a big chunk of their wealth. So therefore, housing portfolio channel is potentially more important than other channels identified in the previous literature. The other thing I also want to add is that German case is also more common. It's not unique. This housing boom without credit boom also found in other countries. Meanwhile, many other countries also have underdeveloped household credit markets. If we look at cross-country level of household credit as a share of GDP, you immediately realize that Germany is in the middle. Around 56% of the GDP is in household credit. It's like other countries as well. Unlike in the far right top, that previous literature who focused on collateral channel has been extensively studied, but that's really an extreme case. So therefore, the housing portfolio channel we documented for Germany has broader implications for other countries as well. Now, let me show you the preview of our results. This paper is mainly empirical, but to really justify the housing portfolio channel, we're gonna first set up a theoretical model with segmented asset markets to guide our empirical analysis and identification in the data. And then empirically, we're gonna directly test the real effects of QE using geographic variation. And then we're gonna study the channels to explain the real effect of QE, which is the housing portfolio channel. Now, what we find is that QE gonna have a stronger impact on output growth in regions with a more land scarcity and hence a tighter housing supply. And this effect is true even with control for other channels and confounding factors. Not only statistically significant, economically, the impact is also sizable. We find that 2 to 3% of growth differential between high versus low exposed regions during 2010 to 2017 can be attributed to the real effect of QE. And moreover, the mechanisms is not through credit market, not through the collateral channel, as in the macro fact you see, and the large share can be explained is the housing portfolio channel that we propose. And quantitatively, it can account for 60 to 80% of the total impact on the regional growth differential, depending on different specifications. Given the housing portfolio channel is so strong in the German data, given that Germany is not uncommon cross-country, the housing portfolio channel also have implications for other countries as well. Now, in the interest of time, I'm going to skip the literature review. And in the remaining part, I will first show you a simple model to guide our empirical analysis and talk about the empirical implication from the model. And then I talk about the data and show you our two main parts of empirical findings. One is on the real effects of QE, and then I'm going to inspect the mechanisms to explain the QE. Later, I will conclude. Now, the model. Our model is rather simple. It's gonna have two blocks. One is on real block, the other is on the financial block. And for the real block, you're gonna have a very standard representative consumption saving problem by a household. Specifically, household gonna save, take the total portfolio return as given. And this return gonna be determined in the financial market. In other words, the household gonna delegate their savings to financial markets, and this rationalize why they take housing returns as given. I would encourage you to think this household as a representative citizen of a German city. In the benchmark model, we only have one region, but extend to multiple regions is gonna be straightforward. So we're gonna think about the cross-region differences as captured by different parameters in the city's housing market, which I will talk about in a minute. Similarly, in the benchmark model, we focus on consumption, but the link to output can be easily introduced if you have endogenous production. In the empirical part, because we don't have regional consumption level data, we're gonna use regional output level data instead. The financial market block, we're gonna combine housing portfolio literature as in Flavin and Yamashita 2002 AR paper with the preferred habitat investor literature as in Vallanas and Villa 2021 econometric paper. Now, the real block, as I mentioned, is rather standard. It's a two-period consumption saving problem. In this framework, we can easily derive the response of current consumption to interest rate. That's a total portfolio return. And the general message is that you can have consumption increases to a fall in total portfolio returns when the consumption is rather elastic. And later, I'm going to show you that the QE will lower this total portfolio return and hence lead to a consumption boom. On the financial market block, we're gonna have two risky assets. We have houses and we have long-term bonds. And these two type of assets gonna have a asset payoff structure. Their returns could be positively correlated. And in this framework, we're gonna have three agents. We have two preferred habitat investors and one national arbitrageurs. And preferred habitat investors, what are they? Well, they capture the idea some markets just have some specific investor basis, and they will have downward sloping on a particular asset. And in particular, they do not do arbitrage across assets market. And in our case, we're gonna have a local preferred habitat investors in the city housing market and with a downward sloping demand curve. This guy can be rationalized as local homeowners, and they're gonna absorb excess demand from other agents. The other preferred habitat investors are national traders in the bond market. They also have a downward sloping demand curve. Those two guys will not arbitrage across market. Who will do? Well, that will be a national arbitrager. And this guy is like a bank or hedge fund, a mutual fund, or ETF. They collect delegated investment from local household, and then they're gonna choose investment in different risky assets. And later they're gonna return these portfolio returns to the local household. And therefore, anything they do affect the returns will also have a real impact in this model. In particular, this guy gonna choose these house holdings, bonds, and the storage technology, which in equilibrium can determine the price of those risky assets. Now that's listed in equation 6 to 8. I'm going to run in one specification to tell you the intuition. Take equation 6, for example. What this guy is doing is to equate the price of asset on the left-hand side with these risk-adjusted returns of these assets. And this is for the house holdings. You can see that you always want to lower your house holding because house is a risky asset on the right-hand side. And moreover, if you have a higher bound, you also want to lower your house holding if the correlation between these two assets are positive. That captures the idea of houses and bonds are perfect substitute if you have a positive correlation. Given this, in equilibrium, we're gonna have a market clearing on both bonds and house market. And in particular, this bond supply is going to be controlled by the central bank. Through QE, they can reduce the total supply of bonds to this bond market. And moreover, the housing market clearing condition is determined at a local level. Demand for preferred habitat investors plus the national arbitrage will equal the total supply of housing in the city. And this H bar difference gonna capture the cross-region differences as well. Now, given this framework, we can have two results. One is that whenever if we have a QE that reduce the net supply of bonds, and meanwhile the national arbitrager will lower the bond holding and bond price go up, bond return goes down. They will also want to do a portfolio rebalancing if bonds and houses are perfect substitute, and in equilibrium, that's gonna drive the house prices, drive down the housing returns. In total, you can also have a case that the total portfolio returns, including bonds and houses, also goes down if the correlation between these two assets are moderate. And given the house total portfolio returns goes down with QE, we can also have a real effect on the local consumption as combined with real block insights. Now, taken together, what is the model implicate prediction we learn from this simple framework? Well, QE can have a real effect. In particular, it works through the housing portfolio channel. Specifically, QE reduces bond supply to private sector, leads to a portfolio rebalancing towards housing market, drives down the housing portfolio, portfolio returns, which can stimulate this consumption and output. And given this empirical prediction, how do we gonna take that to the data? Well, we're gonna think about the cross-region differences captured by the city level housing supply, H bar, and the consumption responses can differ from each other. And therefore, for identification purposes, we're gonna construct a measure at the regional level to identify the housing portfolio channel. And moreover, remember in this framework, the housing portfolio return is a key of our mechanism. We're gonna use the rental yields as a proxy for the expected housing returns. Now, let me talk about why we can use rental yields as a proxy. Well, we're gonna collect the data from the regional level in terms of output and house prices. And in the macro level, our proxy for the monetary policy is one like EONIA, that's a European interbank interest rate, that's proxy for traditional monetary policy. We also have a measure for QE, that's a ECB's balance sheet over nominal GDP. And both of them are macro level variables. Cross-regionally, to achieve geographic variation, we're gonna collect land cover and land use from German Monitor of Settlement and Open Space Development. Those are rather granular level data. We're gonna use this data to construct a size type instrument. And let me present you two sets of a proxy that's gonna be crucial for empirical results. Number one is that we're gonna use the rental yield as a predictor for housing returns. Why can we do that? Well, to achieve this purpose, we're gonna first do a decomposition following the traditional literature on asset prices like Cochrane and Campbell and Schiller, and then run a predictive regressions using long-run data from 1963 to 2009. And through these types of regressions, you can decompose the rental yields either reflect future housing returns or future dividend growth or future rental price ratios. And in those types of regressions, what we got is that the the rental yield or dividend price ratio largely reflects the future expected housing returns, especially in medium to long runs. And in other way to think that a large fractions of variation in expected housing returns comes from the rental yields varies in the medium to long horizons. For that sake, we're going to use the rental yield as a proxy for expected housing returns. And because this coefficient on the predicted regression is close to 1, multiplying this variable by a constant doesn't really affect the effect in our estimating regression. Therefore, in our later regression, we directly put rental yields in our regression to proxy for future expected housing returns. Now, that's the first result I want to highlight. The second one is on the geographic variation. We have shown you in the model that the impact of QE on output growth should be higher in regions with a tighter real estate market. And then to achieve identification, to think about cross-region differences, we're gonna have a supply side measure to capture this cross-region real estate supply tightness. We're gonna use the land scarcity, although to capture the real estate supply elasticity as well. The data we use is land covered by water bodies and urban open spaces. This is consistent with the traditional indicators in the supply side elasticity in the spirit of size. Now, just to show you cross-region correlation between these two measures, you can see that for regions with a tighter land scarcity, these regions also have a lower rental yield and thus a lower expected housing returns. And later, we're gonna use this exposure for two purposes. First, in our reduced form regressions, that's gonna proxy for the housing market tightness. And later, we're gonna use QE times this land scarcity as an instrument for the rental yield. That's consistent with the previous literature. Now, for the later time, let me present you our empirical results. We have two parts. One is on the reduced form results. The other one is to understand what channel explain these reduced form results. Now, in the reduced form results, our econometric specification follows the Chang et al. 2012 AER paper, and on the investment, Alessandro got the 2017 AER paper on consumption. What we do is to regress regional level GDP growth rate on a bunch of controls, in particular, the interaction of macro variable QE times the cross-region measure for land scarcity. Column 1 and 2, you can see we put separately the traditional monetary policy measure, IONIA, and our QE measure. In both specifications, you realize that easing monetary policy can stimulate this output growth, in particular in regions with a tighter land scarcity. But when we put them together in column 3, that's our preferred specification, you see that this QE real effect really dominate. And that thing is not only statistically significant, but also economically significant. And to give you a sense, one standard deviation increase in QE lead to 20 to 30 basis point growth differential across regions per year. Cumulatively, that's 2 to 3% GDP growth. Column 4, we study whether IONIA and QE are substitute or complement. The results is like substitute, but statistically insignificant. Column 5 to 8, we also want to control for cross-region heterogeneity. In column 5, we add the size measure cross-region, that's population density. Column 6, demographic measure, like age above 65. Column 7, that's economic development measure across region, that's agriculture. And column 8 is important because we also control for cross-region differences in the housing supply measure. Because one comment would be that the growth effect we find out may pick up investment in the housing market. But in column 8, you can see once you control for cross-region differences in housing supply, our QE effect is still there. And therefore, this QE effect that we pick up got come from the consumption as opposed to investment. Now, this real effect of QE in the reduced form specification is robust if we add other types of macro variables like fiscal policies, financial uncertainty, and also robust to different measures of QEs. Whether you split the QE among different components, whether you construct the shocks to QE. So the real effect of QE is very strong economically, both statistically. Then the next question would be, what can potentially explains the QE's real effect we find in the previous slides? Here is an important slide. What we do is to add different mitigating factors. The factors could explain the real effect of QE. And in our theory, what we say is a housing portfolio channel proxied by the national rent yields. That's in column 1. As you can see, once you add this rental yields times exposure, it fully absorbs the QE's real effect, both statistically and also economically. Column 2, what we do is to add the term spreads as a potential absorbing factor, because what QE do is to flatten the curve. So it could also work through the term spread. And column 3, 4, and 5, we add into proxies for traditional credit or collateral channel. For example, credit growth in column 3 and mortgage rates in column 5. And also national housing price indexes, proxy for the collateral channel in column 5. In all these specifications, you realize that term spread, credit, and also national house prices also can absorb the QE's effects. So to really say housing portfolio channel dominates, we need to horse them one by one with our rental yields. Why can't we do it all together? Well, because those guys are macro variables. They are highly collinear together. We can now put them together in one regression. So we horse them one by one with our housing portfolio channel. In column 6, we horse them with a term spread. In column 7, we horse with rental yields with credit. 8 and 9, we horse with mortgage rate and national house prices with our rental yields. Altogether, you can see the statistical significance of our rental yields, housing portfolio channel proxy can dominate other potential variables. With one exception, which is the term spread. That's because the rental yields and term spreads are rather collinear together, but the p-value of rental yield is rather low compared to term spread. So taken together, this slide shows you that this rental yield can potentially absorb this QE's effect. In particular, it dominates other potential mitigating factors. This is statistically. Next, we want to understand quantitatively how important our housing portfolio channel is in the total effects. For that sake, first, we run a predictive regression at a macro level to regress the rental yield on the QE, and we also do for other factors. You can see that all the factors will have the expected sign. The only exception is credit. It has the opposite sign. That's consistent with our macro facts. And based on this predictive regression, and then taken together with the column 1 we get in this table, we can decompose the direct channel housing portfolio channel using the predictor of minus 0.044 from QE to rental yields, multiply that number with this minus 0.307 in the column 1. That's a channel of QE affect the real economy through the housing portfolio channel. The 0.003 is the other channels. And based on this decomposition, we found that the housing portfolio channel can explain 82% of the total effect of QE. Of course, this is one specification. We can do different specifications. In particular, in the term spread speculation in column 6, we get 61% of QE is through the housing portfolio channel, 20% term spread, and 20% unexplained. In all specifications, economically, this housing portfolio channel is more important. The next exercise—
You have 1 minute.
Sure. We do is to use this instrumental variable approach. First, we regress regional level GDP on the rental yields, And then we instrument the rental yields through the housing portfolio channel. That's an interaction of QE and exposure measure following Chang and all, and also our IFS paper. In this two-stage least square regression, as you can see, first stage, when QE increases, and you see the rental yields falls more so for regions with higher land scarcity, and this falling rental yields further stimulate this consumption, this GDP growth at different regions. So taken together, this suggests QE affect output growth by lowering this rental yields. That's our housing portfolio channel. And later we also do cross-regional analysis. We find this QE effect is stronger in West Germany, in rich regions, in high population density regions. Those all results are consistent with our housing portfolio channel. Now let me conclude. What we do in this paper is to propose a housing portfolio channel of quantitative easing, and we show it plausible in the simple model and to guide our empirical analysis. In particular, we find strong empirical support in German regional level data, and this housing portfolio channel is not only statistically important, but also economically important. During this period, 2 to 3% can be explained by this channel, and this is controlling for other channels, and the housing portfolio channel dominate other credit and traditional collateral channel. And given this housing portfolio channel is so prominent in the German data, given that German is not a special case, so this channel is potentially have implication for other countries as well. Okay, I will stop here. Thank you.
Thank you, Chang. Discussant is Cristian Badarinza from NUS. Cristian, you have 10 minutes.
Okay, hi, it's good to see everyone. Just checking if you can see my screen.
Yes.
Yeah, okay, great. So thank you very much for the opportunity to discuss this very interesting paper, which I very much encourage everyone to have a look at because it is motivated and it's addressing the essential link between unconventional monetary policy, so the more innovative ways in which monetary policy was carried out in the recent years, the housing market and the real economy, but also because it allows us to think about one of the most puzzling, at least for me, puzzling real estate booms of the last decade, which is going on as we speak in Germany, with the magnitude and the force, which I think is just pretty unexpected, and certainly from this paper I learned quite a bit about it. So now the central mechanism in this paper is one in which the interventions by the ECB, the so-called QE, in the financial market leads to a compression of bond yields first, which is the first step, and then a subsequent reallocation of capital away from bonds and towards housing, right? Ultimately leading to an associated increase in consumption and local output up to a magnitude of around 2 percentage points per year in the treated, in the instrumented regions. So Chang did a great job summarizing the paper, but I think it's basically this figure which is at the core of the identification, right? Because what we see here is a housing boom without a credit boom, and that's key for the ability of the paper to distinguish the effect of QE on mortgage terms as opposed to the direct stimulus that is observed that is sort of modeled, right? So everything shoots up after 2009, rents, prices, but also the price to rent ratio. While at the same time, we see, as Chang greatly mentioned to us just now, a decrease in the in basically borrowing, right? So housing boom without the credit boom, key for identification. Now, in my discussion, I will have two parts. First, I will make some comments about the model, about some aspect which I think can improve the way in which it's then brought to the data. And then I will have 4 points about the data. First, on the home ownership rate, sort of renting versus owning, the housing price cycle in Germany versus other countries, the evolution of incomes, and then the role of migration, which I think also potentially plays a role as a potential confound here. So About the model, very elegant structure of bringing the preferred habitats side alongside the household optimization. I would just think more about two ingredients. First is income expectation. So just basically in the budget constraint in the 2 periods, having a sort of income dynamics which may drive your consumption saving decision, which by the way is the central prediction of the model at the end of the day. And then second, the renting versus owning decision. You know, just basically allowing preferences to depend on housing, because this is key in terms of driving the extensive margin. Now, why does this matter? Well, if you look at the propositions in the paper, basically everything boils down to the condition that the EIS is larger than 1. So the portfolio rebalancing works in the direction in which the data is telling us under this condition, right? Which to my mind, is very much linked and is potentially observationally sort of equivalent with anything which has to do with income expectations. So I hope I'm not wrong here with the sort of understanding the mechanics of the model, but that's what I would think that the EIS has a similar impact to a situation which would explicitly model the changes in income. Of course, it would be great to map this against the data in terms of the micro estimates of the EIS. But then more importantly, now I'm going back to my extensive margin discussion here. If it's truly a portfolio rebalancing story, then we should see at least some effects on the extensive margin, right? Or at least we should have a clear framework to think about rebalancing either in terms of the intensive margin, so same people buying larger houses, or different people entering the market. I'm going to come back to this later, but also I wanted to suggest here, based on some of my own past research, that the HFCS data now has 3 waves, in fact, and you may actually observe this rebalancing. So I did some preliminary work, but I'm not quite sure where this is leading, but certainly the 3 waves allow you to potentially see that rebalancing. Final point about the model is that, again, I hope I'm not misinterpreting the mechanics, because there's no proposition stating that. But you know, what I think I understand is that the QE increases consumption even without the portfolio rebalancing here, just as a consequence of the lower overall portfolio returns, which of course is then potentially ruled out by the instrumentation. But maybe it will be, you know, good to be transparent here about the fact that the impact of QE, so the reduced form effect, is consistent with even with a version of the model which shuts down the portfolio rebalancing channel. And in fact, I think there's a very nice falsification opportunity here, because the reallocation towards housing is actually decreasing, so leads to a downwards bias, I think, in the effect. So put differently, the QE by itself lowers bond returns, increase consumption, right, by bringing consumption more towards the present. Again, EIS is key. But then as we move towards the higher yield housing, yes, the yield on housing is decreasing, but still higher than the bonds. I think this is pushing us back towards lower consumption. Okay, so again, if I'm wrong with my intuition here, I apologize, but my intuition tells me that this is the indirect effect that you could test in the data as a counterbalancing force. Of course, a direct falsification of the rebalancing channel. Right. Okay. Now, I insist with the extensive margin in the model because I'm very puzzled about what we see in the data. So yes, Germany has a very low home ownership rate, but what I'm surprised to see is a decrease in the home ownership rate over the relevant sample period, right? So it seems like the effects that you have in mind occur almost exclusively to the intensive margin, which again, I would just suggest that one should think more about. And this is especially important because over the next slides, I'm going to compare Germany with France and Italy and sort of the Euro area, just to think a bit about external validity, but also to think about the fact that here we have a Euro area program having local effects. So to my mind, this is very interesting because it leads to the old debate that the Euro area is engaged into since its inception, of whether a common central bank is the right way to deal with asymmetric shocks. Okay, so anyway, here's the very heterogeneous evolution of the home ownership rate between Germany and the other countries. But more importantly, I want to look at the housing boom, because the housing boom in Germany indeed looks quite special, right? So if you compare it with France and Italy, we did have a boom in the over the 2000s, but then pretty flat over this period. So I would, again, this is very puzzling to me. So the more we know about what drives this gap, and especially the role of QE in driving this asymmetric response, I think that's a huge opportunity here. Finally, I mentioned income. So here's the evolution of income between these three countries, potentially a key to also understanding the boom, right? So if we look at the evolution of income, we see, and I've normalized them in 2009 to be on the same level, huge increase in Germany, much lower increase in sort of France and Italy, right? So if QE does spill over onto these markets, it does so very, very asymmetrically. But this also tells me that it's quite important to think in the context of the model about the role of income, which is very predictably growing here over the sample period. Finally, last point about, again, something that's quite special in Germany over this period, and we've all sort of read about this in the context of the pandemic, right? The much more pronounced increase in migration compared to historical trends. So over this period, Germany has been a net receiver of migrant flows, especially after 2012, let's say, not only from Eastern Europe, mostly from Eastern Europe, countries like Romania, but also from abroad, as we know, the Middle East and North Africa. But again, this is very different when you compare Germany to France and Italy. And then here's where I want to end with basically the question of whether the land scarcity measure that you exploit is in any way correlated with migration, because sort of Baden-Württemberg, Bayern here certainly are also the places which have received a lot of migration over this period, and just rough inspection here tells me that there could be some correlation between the migration inflow and the land scarcity, let's say, the instrument. Okay, so really great paper. I very much enjoyed it, sort of thinking about the model and the data. From the model, I hope I'm right with the interactive or the indirect equilibrium effects between the portfolio channel and the bond returns. And then in the data, basically the main point has to do with the external validity of the German episode versus the other countries, the role of income and the role of migration in driving cross-regional spreads. Thank you so much.
Thank you, Cristian. Alex or Chang, do you have a quick response to Cristian's comments?
Okay, sure. Thank you, Cristian, for this insightful comments. So let me answer first your question, which is does income expectation matters for this two-period model? The answer is yes, it matters, and I suspect it also have a observational equivalence condition with this elasticity intertemporal substitution. We will definitely have a version that will incorporate this. And in terms of second direct versus indirect effect, yes. So once you have the bond return going down by triggered by QE, the intermediary is going to rebalancing from bonds to houses. The quantitative houses goes up, but the return of houses going down. So you have in mind the counter effects from the quantitative houses. Yes, that's something we can test in the data as well. And one thing I want to point out, the uniqueness of our identification is that, remember, the bond is at the national level, but the houses is at the regional level. So it's really the housing portfolio channel through the houses that gives us the identification for this cross region regressions we run. For this net migration and also the land scarcity correlations, we'll definitely take a look at the data and see whether we can empirically control that and see whether our housing portfolio channel is still there. So we'll definitely do more work. So Alessandro, you want to add? Or?
Yeah, only one addition to what Chang mentioned. Thank you, Cristian, for your thoughtful comments. Intensive versus extensive margins. So we definitely think is extensive margin, and that is at the core of that puzzle with home ownership. So here the idea is that German households are selling government bonds and buying second homes to rent. So that ties in with your immigration story. It's true that there is immigration. Our other paper on this data focused very much on that. We partialize and use the refugee as an identification source, but we are aware of the migration dynamics. And those immigrants are, together with students and young, newly formed households, are those that need to rent at the beginning. And indeed, we are looking also at household level data, and seems to be consistent. How to bring that out in the model is a little bit more complicated. This was a reduced form way, if you will, to do that. And the second comment is on the total return. I agree with you that the story goes through without the delegated investment component, but that is there to give voice to this idea that one particular type of financial investment, second home for rent, so buy to let cash, to bring it into the model. So the question is, what is the relevant return for the household? Is it the interest rate like in the IS equation of a standard macro model, or is really the total return of the household?
Thank you, Alex. Any questions from panelists or attendees? We have 2 more minutes. Comments? If not, let's move on our last paper of today's session.